Everybody, this is Jeff Fowler with the Apartment Owners Association, and it is great to be with you today. Just a shout out to all of you members. Thank you for joining this call. And some of you are brand new members and you may be watching on AOAUSA.com. I want to let you know that you can watch a recording of this after the fact, along with a recording of so many other videos that we've done by going to YouTube and watching it. Just search AOA USA, and that'll be there for you. And today we're going to do a deep dive into some case study and DST portfolio strategies. And before we get into that, AOA has been around for over 40 years, and our goal is really to give you ideas that will help you make and or keep more money than ever before. So that's what we're trying to do. And just real excited about the rent reporting that we have. I think we hit 100 different renters just on the AOA white glove, and that's not even including all the renters that have opted in on our property management software. So that's kind of a cool thing. It's part of your AOA lease now, and so you need to either mark exempt or subject to. But if you are subject to it, and even if you're not, it's nice to offer that, because the renters that do opt into the rent reporting, where it's reporting it to credit bureaus, it is helping them build their credit score. And as you're helping them, they are also prioritizing paying you, and it's kind of an indication that they're going to be a good renter. So that's something that's new. It's a new law that people with 16 units or more need to comply with as of April 1st. And anyway, so we're glad to be able to offer that. And that's just one little tool, but there's so much that we have here to try to keep you in the know on everything that's going on. And we do have some seminars coming up. Super excited about the San Diego Landlording Power Conference. It's coming up on May 22nd, and it's at the Marina Village in San Diego. It's on the wharf, and it's just such a nice, relaxing place to be, and seating is definitely limited there. So sign up for that one if you are wanting to maybe hear about asset protection, or DSTs, or let's see, we have an eviction attorney and landlord tenant attorney coming that'll be speaking, and so many others. So yeah, tax strategies. So there's all kinds of things that we'll be talking about there. So that'll be cool. And then on May 28th in Pasadena, and this is more geared for people who own rental property in Pasadena, because they're going to be talking about Measure H, which is specific to Pasadena, and it'll be at the Hyatt Place, and it is a double header, and we are covering parking on that. So I hope you can make that. And then that's May 28th, but May 15th, I will be having a live stream, just a tenant screening crash course for this year. And before you screen tenants, you just really need to understand what new laws are in place and what new tools are out there and why they're out there. So we're creating that event pretty soon here, but that'll be May 15th. So excited. These are just a few things that we're trying to do to set you up for success with your properties, as everything's challenging, as we know. And I want to give a shout out to Real Estate Transition Solutions for sponsoring this live stream. And they are DST experts. They have 4 offices on the West Coast, and 1 including in Orange County, 1 in San Francisco, that are in California. And they do, I think, at least 220 million of replacement properties yearly. And our speaker today is a partner and chief exchange strategist at Real Estate Transition Solutions. He's a CPA with extensive expertise in 1031 exchange strategies and tax deferral strategies. He leads Real Estate Transition Solutions team of skilled advisors and analysts, serving as both an advisor and advocate for owners of highly appreciated real estate. And that's a lot of us here in California. He also regularly contributes to educational articles and to highly acclaimed publications like Business Insider, demonstrating his profound knowledge in the field. So Austin Bowlin, it's great to have you on today. and I'll let you take it away.
Excellent. Jeff, thank you for the introduction. And as Jeff mentioned, today we're going to be walking through a case study as it relates to designing a replacement property portfolio for an investment property owner using Delaware statutory trusts. Now, the Delaware statutory trust that we'll be discussing in part today is unique in that it is both considered like-kind property for 1031 exchange purposes, but also treated as a security with the Securities and Exchange Commission. And it's important to know that in order to exchange into DST properties, you must be what's considered an accredited investor. Typically, an investor is accredited by virtue of having a net worth in excess of $1 million, not including the value of your primary residence. Quick glimpse at what we'll cover today. I'll do a brief background and bio of our firm, Real Estate Transition Solutions. We'll lay some foundational knowledge down as it relates to the 1031 exchange itself, timeline, mechanics, rules, but just a quick pass through that. And then we'll talk about how to design an exchange strategy, how we look at it when working with a property owner so that it is a seamless and effective process that ultimately moves a owner from where they are today and what they own today toward property that is going to be much more reflective of their goals and objectives. We'll walk through an illustrative case study of two different clients that we worked with, two very different scenarios from one another, both California property owners, and then, of course, share some additional educational resources for the AOA community as well. So as Jeff mentioned, we are a real estate advisory firm that really focuses on serving property owners who are in what we consider to be the third and the fourth quarter of life. So traditionally, these are owners who are in often retirement years, if you will. They own appreciated investment real estate such that if they were to sell it, they would face significant tax consequences. And we know that real estate's very dynamic from an ownership standpoint, given the properties change, the regulatory environment changes around the properties, market conditions change, tenant profile can change. And then on top of all of that, owners' objectives, whether they're wanting to focus on income or appreciation or estate planning or time management, concentration risk, et cetera, those objectives change as one goes through the decades of life. And given that we have 1031 exchanges as an available transaction structure, what we do is we help property owners to discuss and determine their objectives, analyze the properties they own, and if there's a gap between the properties they own today and their objectives, then develop an intentional transition strategy for their investment real estate on, if not a tax efficient, ideally a fully tax deferred basis. We work extensively with passive replacement property options, the Delaware Statutory Trust being the primary ownership structure, and have extensive experience in this space. We've been working with DST Real Estate as a firm for over 20 years now. Have completed well over 1,500 individual investments with our clients directly into DST properties. Currently have, these figures are as of the end of 2024. As of today, probably just about $1.4 billion of DST real estate under advisement with our client base. And importantly, we've only ever had one property have less than a full return of principal upon the eventual sale. So a strong track record from a return standpoint as well. Quick glimpse of some of the key individuals in our firm from a leadership standpoint. Jeff mentioned we're headquartered up in the Northwest in Seattle, Washington, Kirkland specifically, if you're familiar with the area. And we have offices down the West Coast, so Portland, San Francisco, and Orange County as well. We work with property owners all over the United States, a healthy portion of which are California property owners. So with that background on our firm, Real Estate Transition Solutions, let's shift gears and talk about the 1031. The 1031 exchange is a transaction that has been in our tax code, made allowable by our tax code for 101 years at this point. And what it enables is a owner of investment real estate to defer all the tax that would otherwise be due upon the sale. We're talking about federal capital gain tax, federal depreciation recapture tax at 25%, net investment income tax at 3.8%, and state income tax, if that's applicable, depending on the state of residency of the owner, and often the location of the property. All of that tax that can be due, which can be as high as 43.1% for a California resident, can be deferred, keeping those dollars working for you, provided an exchange is performed and replacement property is acquired. Now, there's a term that you hear regularly in association with exchanges, which is like kind. And it's common for individuals when they're first hearing that to think like kind is fairly narrow and rigid. In reality, all property held for business or investment purposes, provided it is located within the United States, is like kind with one another. So now there are a myriad of different strategies and opportunities that can be employed when someone is performing an exchange. Very commonly, our California clients express interest in investing in different states around the country, maybe a more favorable regulatory environment, maybe stronger demographic trends, more affordable cost of living, whatever it may be that's motivating them to look at the Tennessees, the Texases, the Floridas, the Carolinas, et cetera. That's allowable within a 1031 exchange. Also, there are property types that have notoriously low cash flow, like single-family rentals, arguably even multifamily properties, depending on how it's managed, where it may be more in line with one's objectives to exchange into higher income replacement properties. That could be industrial, that could be senior housing, that could be net lease retail or medical office or hospitality, all of which is allowable with the 1031 exchange. Why does someone consider, or why would someone consider an exchange? It's really ultimately due to the fact that there's a gap between one's objectives and the properties they own today. And again, what isn't allowable is the ability to rebalance one's portfolio so their properties serve their objectives. Now, one question we commonly field is, why perform an exchange if I'm going to eventually have to pay that tax anyway? Why not just pay it today? But with how our tax code is written, if you continue to defer your tax liability until eventually you or your spouse pass away in a community property state like in California, then you receive what's referred to as a step up in basis. And what that means is that tax liability that may be deferred over decades of ownership and quite possibly multiple 1031 exchanges is then eliminated for that surviving spouse. And then it's any tax liability that it grows after that point is eliminated again for the next generation, for the beneficiaries. So for many owners that we work with, that is the end goal. And the question then becomes, what form of ownership, what markets, what property types are going to be the best fit for me now at 55, 65, 75, 85 years old? Now, the 1031 exchange itself has a very rigid timeline associated with it. In short, upon the sale of a property, you have 45 days to identify your replacement property and 180 days to actually complete the purchase. But what we're going to talk about today is the steps that we encourage owners to go through well in advance of the actual sale of a property. This is the planning, if you will, the front loading of the work so that there's an intentional strategy put forward and ultimately increasing the likelihood of that transaction moving you much closer to or outright accomplishing your objectives. From our standpoint, it really starts with education. It's incredibly important for property owners to know the options that they have available to them and to understand those options. When we talk about properties that are fee simple in nature, or Delaware statutory trusts, or tenant in common, or properties that are going to be absorbed up into REITs, how ownership structures may need to be addressed, liquidity events, et cetera. All of that gets covered within this educational stage. And for some people, this can last months, and it's often multiple conversations, sharing of educational resources, carving out time to discuss questions that surface, and working with an exchange advisor that has worked through hundreds of 1031 exchanges so you can draw on their experience. Then the focus really shifts over to the property owner in discussing and determining one's objectives. Is someone looking to enhance their cash flow or more focused on total return, let's say income plus appreciation? Are they motivated by tax sheltering? Are they wanting to stage their investment real estate for estate planning purposes? All of those objectives, really looking at a transaction holistically within the context of one's overall financial goals and time management, need to be discussed so that we have a framework for evaluating any options. Once those objectives have been determined and there's an understanding of those objectives, now we start developing the exchange strategy. Some of the necessary work that goes into developing an exchange strategy and executing an exchange strategy needs to start well before the actual sale occurs. An example of this is in California. If you are in a co-ownership arrangement, say you have an LLC with two partners that own the property together and you want to go separate directions, it's recommended to do that well in advance of the actual sale. So again, another reason why we encourage starting this process early. And then ultimately, we'll get to the place of selecting replacement properties, properties that are going to be reflective of those aforementioned objectives. We can always share illustrative properties early to give you a feel for the size and the quality and the return profile. But then ultimately, once you're closer to your transaction, actual candidates for your exchange. So we're going to walk through a few of these steps in the context of an actual example here. Education. Many of the items that you see listed on this slide, and I'm not going to read through all of these, but they need to be covered in the context of this education stage. For some, this is 1 or 2 conversations with some resources being shared. For others, this will last 3-6 months as we're working through making sure that a property owner knows what's available to them, and then understands the mechanics, the timeline, the rules, the requirements, etc. It's also important to understand the ownership structures that are eligible for 1031 exchange purposes. And there are 3 primary ownership structures. There's the Delaware Statutory Trust and the Tenant in Common, both of which are fractional ownership structures. And then there's fee simple ownership, which largely entails acquiring a property that you own and likely manage yourself, but have complete ownership of that property. Now, each of these options are not independent of one another. In many exchanges, they can be mixed and matched together to reflect an exchanger's objectives. Let's pivot over to talking about an illustrative example. So here we have a husband and wife that own a portfolio of residential properties, some single families, some duplexes, and a fourplex in Northern California. Properties have been purchased throughout the early 2000s, self-managed by the owners, and then eventually started using third-party property management, which, as many of you who use third-party property management know, doesn't mean that you're completely free of all responsibility. You still very much need to be looking over that management company's shoulder and guiding them, and there's still management effort required by the owners. The goal here was to not have to manage property and additionally diversify their asset base, diversify their investments, because they were concentrated in one market, which was the Bay Area, a reasonable commutable distance from where Frank and Ann live. They knew that they had a substantial tax liability if they were to just outright sell the property, and they also had a little bit of debt on each of the properties. So in a conversation with an owner, what will then happen is we'll move into unpacking those objectives further. And I've touched on a number of the objectives that will commonly surface. It can be financial objectives such as enhancing income or maximizing total return, focusing on appreciation. It can be estate planning. It can be, how do I stage my investment real estate such that if one of the spouses who takes lead on the properties were to pass away, the other one is not having to scramble to figure out, how do I manage these properties or sell these properties? How do I stage my investment real estate for a transition down to my beneficiaries, say my adult children, without forcing them into a co-ownership, co-management situation? For some people that have larger estates, it's also looking at, how do I stage my investment real estate so that I'm going to potentially be able to mitigate what could otherwise be an estate tax liability. Right now, we have a very high federal estate tax exemption amount, For a married couple, it's sitting north of $27 million. But that exemption amount is scheduled to come down to $10 million unless there's extensions to the Tax Cuts and Jobs Act. So that will end up looping in a lot more owners who are then saying, hey, I might have an estate tax issue unless there's some sort of extension to the higher exemption amount. Concentration risk, reducing one's overall risk profile, maximizing the tax sheltering on the income in which one earns, time management. These are many of the dynamics that need to be discussed in determining those objectives. Here in the case of Frank and Ann, their four primary objectives were one, wanting to defer their entire tax liability because they knew there would be significant tax consequences upon the sale of their portfolio. Not wanting to have any management responsibility, clearing up that free time so that they could spend time with their grandchildren, travel, pursue their hobbies, whatever it might be. They wanted to, at a minimum, replace the income that they're currently earning from their property, ideally actually enhance that income. And then they wanted to focus on high quality, typically newer construction properties in strong markets where we see the demographic trends supporting future appreciation. Now we move into the actual design of the exchange strategy. In the case of Frank and Ann, Delaware statutory trusts, as a way for them to exchange into owning a fractional interest of large institutional properties, was the best fit. And there's a number of reasons why that's the case. On one column here, you see all of the benefits associated with DST ownership, and it can serve to address many owners' objectives, especially when they're in those more traditional retirement years. But importantly, it's not a silver bullet. It's not the perfect replacement property option for every owner profile. It is an inherently illiquid investment, which is something that individuals who are contemplating an exchange into DSTs need to be familiar with. It is still very much investment real estate. That's why it's eligible for 1031 exchange purposes, which means returns are not guaranteed, although they do tend to be very stable and predictable. And theoretically, should there be any changes to 1031 exchange treatment in the federal tax code, that of course would be something that needed to be worked through as well. Now we go into actually designing the exchange strategy. Which properties are going to be sold? When are they going to be sold? Should there be improvements made to the property before selling the property? Is there a goal of having immediate or near-term liquidity? And so given the loan balances were fairly low on these properties, should there be some short-term debt placed on the property to have tax-free refinance proceeds in advance of the sale? We did not have a co-ownership arrangement with these properties, but I made reference to that earlier. If that's present in the transaction, that's something that we want to make sure to work through as well. And then now we're going to start selecting specific properties that are going to be candidates for Frank and Ann's exchange. Now, ultimately, what is critical when selecting, especially DST replacement property, is a rigorous, extensive due diligence process. This is something in which RETS has invested as a firm in heavily over the last 10 years, and something we pride ourselves in. We have an in-house 5-person due diligence team that spends all of their time underwriting and evaluating DST sponsors and each and every property that those sponsors who make it through our due diligence process put forward. So it will, if anyone's interested in hearing more about this process, I would encourage you to visit our AOA hub page, in which we have a recorded webinar that details the due diligence process. But if you're ever contemplating exchanging into DSTs, I would very much seek to understand what that firm who you're communicating with's due diligence process entails, who performs that due diligence, are they independent and agnostic to the solutions, and are the insights being extracted from those properties that are necessary in order to make informed decisions. In Frank and Ann's scenario, ultimately what they exchanged into was a very broadly diversified portfolio among various markets and various property types. You can see here the allocation of the just over $6 million of exchange proceeds that resulted from the sales of their properties. And again, broadly diversified by property type, broadly diversified from a geographic standpoint, generating just over 5%, 5.26% first year cash flow on $6 million of equity exchanged. These same concepts would apply if someone's selling a single property for $750,000 or a larger multifamily property for $8.5 or $10 million or anywhere in between. Let's shift gears quickly here. We don't have too much time left, so I'm going to move fairly fast, but a different couple and a different set of objectives that we work through. So here we have husband and wife, Ollie and Catherine, that own two single-family rental properties. And this is a common scenario we see where someone relocates. In this case, Ollie and Catherine moved from Southern California up to Seattle. One property had been an investment property for quite some time. The other was more recently an investment property because they held on to that property when they moved to Seattle, and it used to be their primary, but had been rented out for 3 years. That presents a unique scenario because when you're selling a primary residence or a property that's been a primary for 2 out of the last 5 years, you have what's called a Section 121 exclusion available to you, which as a married couple enables you to take $500,000 of gain tax-free. And then you can perform a 1031 exchange for the remainder as long as it was an investment property in the year in which it was sold. You can see the objectives that Ollie and Catherine shared with us. These individuals were still gainfully employed. They were not focused on maximizing cash flow, instead wanted to look toward total return, appreciation, and tax sheltering. So in this scenario, when we look at how that tax liability shakes out for a home that was previously a primary residence and then became an investment property for 2-3 years and then is sold, if the purchase price is lower than the sales price, so the property is appreciated in value, that delta between the two would typically be taxed at 20% plus 3.8% plus California state income tax. But because it was a primary residence for 2 out of the last 5 years, they get to apply their Section 121 exclusion. So Ollie and Catherine were actually able to take $500,000 of sales proceeds tax-free and then perform a 1031 exchange with the remaining balance. The replacement property portfolio that they elected to exchange into was shaped differently than what we saw with Frank and Ann's portfolio. Less of a focus on maximizing cash flow, more focus on appreciation. And so in turn, what you're seeing is all short duration lease properties, multifamily, senior housing, student housing. First year cash flow in this scenario was in the mid 4% range, plenty of tax sheltering being generated from the portfolio, all of the properties located in non-income tax states, expecting a 5 to 7 year hold period. When those properties that they invest in eventually sell, they'll receive their pro rata share of all of the sales proceeds, including any appreciation the property realizes. As far as additional educational resources go, if you are interested in looking at properties, Delaware statutory trust properties that have successfully made it through our firm's due diligence process, you can visit our DST marketplace. This is a great opportunity to get to see the size and quality and caliber of those properties. The general public can see properties that are no longer available for investment, illustrative closed properties, and if you request access, then we can share currently available properties with you as well. Additionally, if you visit our AOA hub page, which you see at the bottom of the slide here, re-transition.com/AOA, you can download our guide to investing in DSTs. If you're just starting your educational journey as it relates to replacement property options, this is a great resource available to you. Complimentary, it's about a 28-page guide that gives an overview of the history, the structure, and the mechanics of DSTs. And if you have specific questions or would like to discuss your overall situation, brainstorm some solutions and ideas, then I would very much encourage you to reach out to have a complimentary consultation with one of the advisors on our team. You'll leverage their experience, having worked through hundreds of exchanges and a full due diligence team supporting them in the background. so that then your questions can be addressed and different ideas can be discussed and put on the table. And then webinars are a near weekly occurrence here at RETS. You can see some of the upcoming presentations in which we'll be hosting on the 20th of May. We'll be comparing side by side various exit scenarios for investment property owners, recognizing one's tax liability, exchanging into a fee simple property, or exchanging into Delaware statutory trust property. And then we will also be walking through our due diligence process in early June as well. Well, Jeff, that's all I have on my end. I've covered a lot of information there, but want to make sure we have some time for Q&A as well.
Great. Thank you so much. Yeah. So if you're watching from AOAUSA.com, there's the blue help button down on the bottom right side. You can put your question in there. And I like that. I really like case studies. And so one of the questions that people ask all the time is, well, how much does a cash flow? And obviously these examples is not a promise of what's going to happen in the future, but it was 5% for that first one. Is that right?
5.26% in the first scenario.
Uh-huh.
And it depends on how the portfolio is designed and
Right.
what one's objectives are. But 5% first year cash flow is a very achievable benchmark, if you will, for a broadly diversified portfolio. Typically, most DSTs that make it through our firm's due diligence process, they'll range anywhere from starting cash flow in the mid 4% to as high as 6%.
And then the second case study there, it sounds like they took out 500,000.
They did, yes, yes.
And so that, a lot of people ask, can they do a partial exchange? And so
you can always do a partial exchange, which means you're recognizing some tax and exchanging the remainder. In that particular scenario, though, because that property that they were selling, the single family rental, had been lived in as a primary residence and then rented out for only 3 years, they were both eligible to take the 121 exclusion, having lived in it as a primary for 2 out of the last 5 years, as well as perform an exchange, because the classification of the property at the time of sale was an investment property. So that enabled them to take 500,000 of the sales proceeds tax-free and then exchange the remaining portion.
Yeah, and just right now in the market, what are you seeing? Are you seeing prices soften some?
In terms of the DST properties or the properties that our clients are often selling?
Yeah, the DST properties.
No, I mean we've seen property values come down if we go back to what is looking like peak pricing end of 2022 before interest rates started to go up. We saw property values come down in the, call it 12 to 18 months following that. So maybe into early 2024, but largely they've held flat and been stable since that point. And I expect that now that a lot of the new multifamily supply has been worked through and there's very limited new deliveries happening behind it in the markets that we focus on, that should create a return to rent growth. We will see those property values start to grow again. And if we get any help from a borrowing cost standpoint, from an interest rate standpoint, that will only amplify it. But I think it's a great opportunity right now to be able to sell a property that someone owns and manages today in exchange into DST properties that they have come down compared to 2022. You'll call it 10 to 15% and are well poised to then ride that next cycle. A lot of people who track institutional investment in real estate are saying that this is arguably perhaps one of the best buying times since, call it 2011 or so, where the medicine's been taken, there's enough confidence in what the future is going to look like, and we should be well poised for that next cycle. No one knows how long that cycle will last, but historically, real estate cycles have been 5 to 7 years.
Yeah, lots of uncertainty out there with tariffs on China, not necessarily pegged yet, and the impact that might have on new construction.
I mean, I think that new construction has only one path forward, and that is getting more expensive. And ultimately, when replacement cost goes up, when the cost of building a competing property goes up because materials cost more, labor costs more, the permit fees continue to grow, the permit timeline continues to elongate. Ultimately, that coupled with rent growth helps to lift property values for existing supply. So I don't see that being a headwind as it relates to the properties that our clients are investing in today.
And let's see, we have Paul on YouTube here. Hi, how soon should we start the process in relation with the sale of my rental property?
So I would start the conversation regardless of whether you're contemplating selling a property in the near term or the medium term, because there are some of these components that I made reference to that in a exchange strategy, it's helpful to have some time to work through it. A refinance, a legal entity restructuring to address a co-ownership arrangement, how you address your tenants and leasing and potentially some physical improvements to the property. So it's never too early to begin that process. We'll often be in communication with owners for 6 months, a year, 2 years, 3 years before the sale of a property actually occurs. Now, as it relates to the actual sale itself, maybe 6 months or so before the sale makes sense for beginning to talk with the brokerage community and selecting who you're going to work with. I'm a proponent of selecting the broker that you're going to work with sooner rather than later, because ultimately you're going to pay the same to work with them, and you might as well get as much value out of them as possible. And they should be able to provide recommendations as well, especially as it relates to your leasing strategy, your rent roll composition, and any physical improvements to the property, so that you can maximize value on sales proceeds. Not all physical improvements warrant being done before selling a property, because not every buyer will pay for all those improvements. So being smart about what you choose to do in that 6 month period, year period leading up to the sale.
Big. And so we talked about the cash flow. What about appreciation? What has that been looking like when actually the property's sold? It's usually like 5 to 7 years holding period.
5 to 7 years is the average hold period. It depends on the property type we're discussing, just like cash flow. But typically we're underwriting, when we look at income plus appreciation, we're underwriting to high single digit, low double digit annual rates of return. And to give a feel for the range, a property type like industrial, where you often start with a little bit higher income, it should be a very stable, very predictable income stream. Maybe we're looking at starting cash flow in the low to mid 5% range, growing up to, let's say, 7.5%, so averaging around 6.5%. And alongside of that, perhaps 3 to 5% annual appreciation. So that would put us right in that 8.5 to 11.5% range, or 9% to 11% range for average annual rate of return. Multifamily has historically had the highest average annual rate of return on properties that we have clients invested in at 13.6%. Cash flow there may start in the mid 4% range and grow up to, let's say, 7.5%. And then alongside of that, we've had, call it 5 to 7% annual appreciation.
And this might be our last question unless someone squeezes in another one, but here's Paul. I own a property in a 50-50 partnership. If I do a 1031, does my partner have to do the same thing, or can he cash out of this share?
That's one of those elements that we want to have the conversation sooner rather than later, because it depends on how title's held to that property and how it's reported for tax purposes. So if Paul and his partner own the property in a tenant in common, then they absolutely can go separate directions upon the sale of the property. One could exchange, one could pay tax, or vice versa, or both could do separate 1031 exchanges. If they own it in an LLC, technically the taxpayer on title is the LLC, not the individuals. And so that LLC must stay in place through the exchange, which means they either exchange together or they pay tax together, but one cannot go one direction, the other another direction.
Gotcha. Okay, Paul, again, what are your recommendations when a property is debt-free before the 1031 exchange? Great question.
It is a great question. And it depends on the owner's objectives. If you do not have any debt on your property, now you can look at replacement properties that also do not have any debt, or you can take on some leverage in order to maximize appreciation potential and increase your tax sheltering that you're going to receive from that property. Alternatively, before the sale, what you could do is you could also consider refinancing the property and pulling some equity out of that property, getting some tax-free refinance proceeds, which creates liquidity, and then selling the property with some debt on it, knowing that you can replace that in the exchange. But that's a great scenario to have a conversation around and kind of look at both different solutions and outcomes, and then be able to compare and contrast the two.
Excellent. Austin, thank you so much for being
My
with us
pleasure, Jeff.
today.
Yeah, always enjoy talking with the AOA community.
Okay, well, we will see you next time. And thank you everybody for joining. And yeah, every week we have something going on just about. And again, on May 15th, I'll be sharing on tenant screening crash course. And then, yeah, we have the Landlording Power Conference in San Diego on the 22nd and in Pasadena on the 28th. So hopefully we'll see you guys sometime soon.
Excellent. Have a great afternoon, Jeff.
All right. Thank you. You too. Take care.